Okay guys, this is walking through the entire Baldwin Company capital budgeting example. I went through and added a bunch more slides than what we had seen previously to make sure that it's very step-by-step so that you understand this more challenging example, which then will help us ensure that you understand capital budgeting. Okay, so the Baldwin Company is looking to start a bowling ball business. And when they look to do that, they've got some test marketing that's been done. They spent $250,000 to do that marketing. Because they have already expended that dollar amount and they have to pay it whether or not they go forward, it is a cost that is relevant to the company, but it is not relevant to the bowling ball project. So the company has to pay that $250,000, but because they have to pay it regardless of whether or not they go forward, it is not a relevant cost to this particular project. So we're going to ignore that number. They have a factory site that if they sold it, they would get $150,000 for it. It's not being used right now. So the Baldwin Company can assign that $150,000 to the bowling ball project, but the bowling ball project is responsible for that cost. Ordinarily, at the end of the life of the project, they'll recoup that $150,000. The project will recoup it as they sell the land or sell the factory space later on. The bowling ball machine is going to cost $100,000. It's going to be depreciated on an accelerated basis for 5 years. And in order to get started, we have to increase our working capital by $10,000 initially, and then we're going to have incremental increases in working capital as our sales numbers grow. And indeed, our sales numbers are going to grow. We see they're $5,000 in the first year, then they grow up to $12,000 in the third year, then they start to decline. That's why it's only a 5-year project. They expect to market for about 5 years, and after that, they think the decline is enough that it won't be cost-worthy to continue. The price of they're going to sell these balls for is $20, and that in year one, and then that price will increase by 2% per year. So it's $20 the first year, $20.40 the second year. So they're just going to keep increasing that price. Production costs are going to start at $10 per unit, and they're going to increase by 10%. So again, our numbers decline, our sales numbers decline, and our costs keep going up, which is probably why they can only afford to do this for 5 years. Inflation's 5%. We'll see what we do with that later on. And working capital, to get us started, in addition to buying a machine and assigning some factory space, we're also going to have to buy some inventory, and so that becomes part of the cost. And now we have seen this spreadsheet, and the spreadsheet, this slide becomes really confusing. So I'm trying to break it down into the subcomponents. So first, we're going to focus on the initial outlay. So when we do NPV problems, we have an initial cost and then some positive cash flows. So what is that initial cost? Well, it's not the marketing cost because the marketing cost is sunk. That's no part of this project. It's the $100,000 for the machine. It's the $150,000 opportunity cost for the warehouse. It's the $10,000 growth in net working capital for a total initial cost of $260,000. Okay, so that's the initial outlay. Ignore this 10 here for now. We're going to see what this means later on. That's not part of our initial outlay. So we have year zero cash flows now. Altogether, $260,000 to get this project up and going. All right, next we want to figure out these depreciation numbers. And so what we know is that it's an accelerated depreciation schedule. The cost of the machinery is $100,000. That's the only thing we depreciate. We don't depreciate the working capital. We don't depreciate the warehouse. So we're taking this $100,000 machine and depreciating it. And in the first year, it's going to be a 20% depreciation. So $100,000 cost, 20% means our depreciation in the first year is $20,000. In the second year, it's $32,000. It's 32% of the $100,000. So you go back to that same initial cost of the machinery, $100,000, and it's going to be 32% depreciation, which is 32%. So it would be $32,000. So what this sheet shows you is that depreciation in year one is $20,000. This is an accumulated depreciation number. In year two, remember depreciation was $32,000, so we have accumulated $52,000 in depreciation. In year three, our depreciation is 19.2% or $19,200. So altogether, by the end of year three, we had accumulated $71,200 in depreciation. And onwards we go. So by the end of the life, we have depreciated $94,240 of that $100,000. This line is supposed to make it easier for you to understand what's going on, but I think it's confusing. So what it's telling you is of that $100,000, in the first year we've depreciated $20,000, so we have $80,000 left of value. In the next year, we're depreciating 32% or $32,000 additionally, which gets us to this $52,000. It's the $20,000 initial plus an additional $32,000. So by the end of year 2, we've depreciated $52,000, or what we have left to depreciate is $48,000. The reason they set it up this year is because we're going to need this $5,760 when we go to figure out our salvage value. So this is not a spreadsheet. This is just trying to help you see how they came up with the salvage value. So depreciation, as we see here, is we have the schedule. It's 20% of the $100,000 the first year, 32% of the $100,000 the second year, 19.2% of the $100,000 the next year. And you'll see our project only lasts for 5 years. So at the end of the 5th year, we still have 5.76% that hasn't been depreciated. So that is going to become relevant when we start talking about capital gains. So the acceleration schedule allows us to write this machinery off over 6 years, but we're actually only going to run the project for 5 years. So we're going to have some remaining balance of the initial $100,000 investment that has not been fully depreciated at the end of the life of the project. And these accelerated schedules are set up according to GAAP accounting, and so the IRS decides how quickly we can depreciate this asset. They don't care if it's a 3-year project. We can't depreciate it any quicker than 6 years total. So that's why we have a balance at the end of the life of this project. So let's figure that out. So we already did this $100,000 and the $260. We did the initial outlay. We just talked about this $20,000 and how we got those accumulated depreciation figures. And remember, the $100,000 minus $20,000 is how we got to that $80,000. $100,000 minus $52,000 is how we got to the $48,000. And at the end of the life, after 5 years, we still have $5,760 worth of asset value that hasn't been depreciated. And what this problem tells us is that we can sell this asset at the end of the life for $30,000. So what we're going to do now, I think what we're doing now, is trying to figure out how we come up with this $21,760. So where does that come from? So we spend $100,000 to acquire the project initially, to acquire the equipment, but at the end of the life, we're going to get a cash inflow of $21,760. So where did that come from? Well, here's what happened. They told us that we're going to be able to sell the equipment for $30,000 at the end of the life. So we're going to get $30,000 for it. On the books, it's worth $5,760 because we haven't fully depreciated it yet. So the difference between what it's listed for on the book of $5,760 and the $30,000 that we're going to receive is $24,240. That $24,240 is called a capital gains. And capital gains means we're earning more than what the asset is worth. Well, the government says capital gains don't belong to you. We got to share them. And so the government wants its share of that $24,240. And its share is the tax rate, or 34%. So the government is going to take 34% of the capital gains of $24,240, or the government is going to get $8,242. So remember, at the end of the life of this asset, we're going to sell it for $30,000, which is a cash inflow. But of that, we have to pay the government $82.42, which is an outflow. So our after-tax salvage value becomes $21,758, and we see that on our spreadsheet, or on our slide right here. So $21,758 rounded to 21.76. So again, we get $30,000 for the asset, but because it's been depreciated down to only be on our books for $5,760, we're going to have to pay the government taxes on that capital gains. So the after-tax salvage value that we get to keep is the $21,758. The 5,760 is an accounting number. That just helps us to figure out what our capital gains is. That's not relevant to the cash flow other than helping us figure out the capital gains. What's relevant is the cash in, 30,000, less the cash out, which is the tax that you have to pay of 8242. Okay, so now we have this number. All right, the next thing we need to think about is this opportunity cost. This is a cash inflow in year 5. And you typically see with projects, we have all of our initial outflows, and then we have cash flows over the years. The last year of the project, there's usually a lot of recovery. So we recovered some capital gains here. Now, we were charged $150,000 for the use of the warehouse. At the end of the life, we don't need the warehouse anymore. We don't really care what the company does with it, if they sell it or if they keep it. Either way, it goes back to the company, and that $150,000 becomes a cash inflow for our project. We're just assuming they're going to sell it and get that same $150,000. You can argue that they should get more than that because real estate prices are going up. You can argue that they should get less because it's in a community where the value of the land is deteriorating. If you have a legitimate reason for thinking the value is something other than $150,000, use that number. But to the best of our knowledge at this point, we expect we're going to be able to sell the warehouse for $150,000 at the end of the life of the project. Okay, so what have we done? We have done the initial outlay in the salvage. We have figured out what these depreciation things are. We have this $150,000, and we have our initial outlays. All of that's done. We're going to skip the working capital for a minute. We're going to come back to rows 5, 6, and 7 in a couple of minutes. We've got to do a couple things before we can get there. And that's the $150,000 I just showed you, how we came up with that number. So now what we need to do is, in order to figure out our cash flows, we have to make some projections. So we have to project what our sales are going to be, and we have to project what our costs are going to be. And we already figured out our depreciation. We have that depreciation schedule. It's 20% and then 32% and 19.2%, I think. We know our tax rate's 34%, so we can figure out all of those items that go into our pro forma income statement. So the next thing we want to do is build our pro forma income statement. And when we do that, remember, here are our sales figures each year, and they said that we're going to sell our product for $20 the first year. $20 times 5,000 is $100,000, so that's our first year. The next year, we're going to sell 8,000 units, and they're going to sell at $20 times a 2% markup, or $20.40. So $20.40 times 8,000 is equal to this 163,200. The next year it's going to sell for $20.40 times a 2% increase again, and we're going to sell 12,000 units. So go through and make sure you see where these numbers come from. Each year the price goes up by 2% more, and the number of units that we sell are 5,000 in year 1, 8,000 in year 2, 12,000 in year 3, 10,000 in year 4, and 6,000 in year 5. Okay, that's our sales numbers. The next we need is our costs. And they told us in the problem that, again, we're selling the same number of units. They're selling for, the costs are $10 in the first year, and our costs are going to increase by 10% a year. So of those 5,000 units we sell, the cost is going to be $10 per unit, or $50,000. The next year we're selling 8,000 units, and the cost is $10 times a 10% increase, or $10 plus $1, $11 times 8,000 units means our costs are $88,000. And the next year, it's going to be the $11 per unit cost times a 10% increase, so it's going to be $12.10 times 12,000 units. That's how we're going to get that 145. So each year, the costs are going to increase by 10%, and the number of units sold are the same as before. The 5,000, 8,000, 12,000, 10,000, and 6,000. All right, so we're getting close. So we have our sales and our operating costs. The next thing we need is our depreciation. We already did our depreciation schedule, so 20% on 100,000 is 20,000 in the first year. The only thing to remember with accelerated is the accelerated always goes back to the initial cost basis. So the next year it's 100,000 and a 32% rate, or 32,000 in costs. So each year those are our depreciation costs. Now, and that gets us to our earnings before interest and taxes. Remember, when we're doing cash flow analysis, we never include interest expense. We account for that elsewhere. We'll get to that in a couple of chapters. So earnings before interest and taxes is the same as our earnings before taxes when we're doing a cash flow analysis. So what we have right here is we have figured out through line 11. We have our sales, less our operating costs, less our depreciation costs. Probably the biggest problem I think students have with these problems is remembering that you have to include depreciation costs. So your operating costs are not including depreciation, so you need to subtract those out separately. So we've got our income before taxes. They just tell us our tax rate is 34%. Someone will have to tell you what your incremental tax rate is. So that allows us to get our taxes. It's 34% of $30,000 or $10,200. And that gets us our pro forma net income statement. Okay, so we've got all our pro forma net income. That's the pro forma income statement is done. And if you were an accountant, you're good, you're golden. But we're not accountants, we're in finance. And so now we have to take those income numbers and convert them to cash flow numbers. And it's really important because if you look, these depreciation figures are pretty substantial and they're having a pretty big impact on cash flow. So we need to convert these net income numbers to cash flow numbers, and we can do that nicely. Remember, our formula for operating cash flow is EBIT plus depreciation minus taxes. So how did I get this 3980? I took EBIT of 30. I added back depreciation of 20, and I subtracted out taxes of 10,200 to get to this 39,080 figure. So we have our operating cash flows. So now we're making some pretty good progress on that spreadsheet. We know our initial outlay was a negative 260,000. We know our salvage value in year 5 was 21,758. On the spreadsheet, it says 21.76. We know we can sell the warehouse for 150,000. We know our operating cash flows each year. The next incremental cash flow we need is our net working capital. And if you remember, we had to spend 10,000 initially in order to get up and going. But oftentimes when a company is growing, they need to continue to grow working capital. And while we spent 10,000 initially, in the future, working capital is going to be 10% of sales. And in finance, we're always interested in incremental cash flows. When we're looking at this Baldwin company, we don't care what the company's overall cash flows are going to be. We want to know how the company's changed if we go forward with this project. So we're looking at cash flow specific to this project. We also have to look at working capital specific to this project. So working capital is going to be 10% of sales each year. And so the first thing I did is this yellow line. I included all of the sales figures. And if you go back to our pro forma income statement, you'll see I pulled those right. Those are just the sales revenues that we calculated a few moments ago. Now the next thing I want to do is figure out what my working capital needs are. So it's 10% of sales each year. So in year 1, 10% of the 100,000 means my year 1 net working capital is 10,000. In year 2, 10% of 163,200 is 16,320. So each year you can figure out your net working capital. What we care about in finance is not what the total working capital is, but what the change is. So any buildup in working capital I have to finance. Any reduction in working capital is a source. So if we're selling off inventory, that's a source. So in the first year, our working capital needs are $10,000. We already have $10,000 because that's how much we built up initially in order to get started. So we don't have any incremental working capital needs in year 1. In year 2, our working capital went from $10,000 to now needing $16,320. So I need an additional $6,320 in working capital. I'm building my inventories. Because I need more, I'm going to have to fund an outflow of an additional $6,320. The next year, my working capital has gone up again, so I have to fund an additional, I have to fund an additional $8,650 worth of working capital. Now, in year 4, remember, by year 4, the numbers began declining in terms of our sales numbers. So our working capital needs actually decline in year 4. They're down to $21,220 from the $24,970 they were the year before. So in year 4, we actually have a source of 3,750 of working capital. Okay, so in year 4, we started selling off some of the inventory that we'd been building up. And what we presume is in the last year of the project, all of the working capital that you've built up through time, you recover all of it in the last year. And you recover all of it at market value. Now, you may have reason to believe with your company that it would be something greater or most likely less than market value. That's what should be built into your model. But for this example, we're assuming we can recover all of the working capital at market value. So what's the working capital? Let me change colors to make it a little easier to see here. So what's the working capital we built up? We spent $10,000 initially. We spent $6,320 in the second year. We spent $8,650 in year 3. We recovered $3,750 in year 4. So if you add all those together, they sum up to $21,220. That's how much we've spent on working capital in net up through year 4. So in year 5, we're not going to keep buying raw materials. We're going to use up all of that working capital. We're going to collect on all of our accounts receivables outstanding. So in year 5 of this project, as we're wrapping things up and we're getting rid of we're salvaging the equipment and we are getting recovery on the warehouse that we used, we're also getting recovery on working capital, and we're going to have a cash inflow of $21,220 in the 5th year of the project. Okay, so what do we know? Our salvage value is $21,758. We're going to sell our warehouse for $150,000. We're going to recover net working capital of $21,220. So from our investments that we had to make to undertake this project, altogether, we're going to have a cash inflow in year 5 of $192,978. I think on the spreadsheet, because we simplify it, it's 192.98. But in essence, this is what we're recovering in the last year. So let's look at our spreadsheet now. We have this $260,000 from before. In year 1, we don't have any additional working capital expenditures, so the only cash flow we have is our cash flow from operations. In year 2, we had cash flow from operations of $60.51, but we have to subtract out the investment we made in building working capital, so our cash flow in year 2 is $54,190. In year 3, we also had a cash flow investment in working capital, so our overall cash flow in year 3 was $66,850. In year 4, we had operating cash flows $56,150, plus we had a little bit of working capital recovery of $3,750. So our cash flow in year 4 is $59,900. We have 2 sources of cash flow in year 4. And then in year 5, our cash flow from operations was lower, $31,670, because we're winding down the business. Our cash flow from investment is at $192,978, I think is the actual number. And we get that from our salvage value plus our working capital recovery plus selling that warehouse. So when we add this $192,980 to the $31,670, our cash flow in the 5th year, it becomes $224,650. They've told us our cost of capital is 10%. So now we're just doing a straight NPV problem. And when we do that, if we expend $260,000 initially, based on the projected cash flows, we're going to end up with an NPV of $51,590. You could, if you wanted, you could also calculate your payback period if you wanted to. They only asked us to do an NPV. So the NPV is positive. So in essence, what you would say, if we expend $260,000, if you take into consideration all of the projected cash flows and the riskiness of these cash flows, our company is going to be better off. And the amount that we're better off is $51,590. If you're using your calculator, there's the calculator keys for this. And that is essentially the entirety of the Baldwin example. I hope you take a couple of minutes to go back through and look at it, make sure it's making sense to you. You can refer to this video over and over to just check and see and make sure, read the problem in the book, look at the video, and make sure that it's making sense to you. I'm now going to create a separate video that finishes out the chapter, and then we'll also walk you through the examples of those couple of problems that I'd like you to do as well. So stay tuned for another video.